95% of traders lose money, and that number isn't random. It's a signal, a loud, undeniable clue the market keeps flashing over and over again. Because if almost everyone is losing, it means almost everyone is thinking the same way. And that shared perspective, it's deeply flawed in ways most people never question. Think about what happens the moment you open a chart. Your eyes go straight to the usual suspects: support, resistance, trend lines, indicators, candlestick patterns. It feels structured, predictable, almost like solving a puzzle. If resistance breaks, you buy. If support breaks, you sell. RSI oversold? A reversal must be coming. Bullish engulfing candle? Time to go long. It all sounds logical on the surface, clean, simple, reassuring. And that's exactly why it's taught everywhere. Courses, YouTube videos, beginner trading books. But here's the question that should stop you in your tracks. If everyone is learning the same strategies, why do 95% still lose? This is where real understanding begins to unfold. Because the market doesn't operate like a textbook. It never has. It's not a neat system of patterns. It's a living environment driven by orders, behavior, and liquidity. And this is the layer most traders never truly see. Retail traders look at charts. Professionals look through them. They don't just see patterns, they see people. They study how buyers and sellers behave. They track emotion, fear, greed, hesitation. But above everything else, they focus on liquidity, because every major move in the market is powered by liquidity. Now pause and think about this. If a massive institution or hedge fund wants to enter a position worth millions or even billions, can they just click buy with one giant order? Of course not. That kind of order would instantly push price higher, ruining their entry. The more price moves, the worse their position becomes. So what do they need? Liquidity. They need sellers to buy from, buyers to sell to. That's why large players are constantly hunting for areas where orders are stacked, because that's where they can execute without exposing themselves. And here's the uncomfortable truth. Those areas are exactly where retail traders place their trades. You spot a clear swing low. It looks obvious. You buy. Then you place your stop loss just below it. Thousands of other traders do the exact same thing. Now ask yourself, what's sitting below that level? Liquidity, stop losses, sell orders, forced exits, a pool of fuel waiting to be used. And suddenly, price drops fast. Stops get triggered. Panic kicks in. Traders exit. Then, almost instantly, the market reverses and shoots higher. Most beginners call this manipulation, but the reality is much simpler. The market didn't trick you. It moved to where liquidity existed, because liquidity is what drives movement. Now flip the scenario. Price is trending upward. A clean resistance level is forming. Everyone sees it. Twitter is talking about it. Analysts are pointing it out. Traders are waiting, anticipating the breakout. Then it happens. Resistance breaks. A strong bullish candle appears. Volume increases. Excitement builds. This is it. The breakout is real. Price is going higher. This feels safe. But in that exact moment, smart money isn't celebrating. They're asking a completely different question. How many breakout traders just entered? How much liquidity just became available? Because very often that breakout you're buying is where professionals are quietly exiting. And that leads to a powerful realization. The market rarely rewards what is obvious, because obvious setups attract crowds, and wherever crowds gather, liquidity gathers. And wherever liquidity gathers, smart money follows. This doesn't mean breakouts always fail or that support and resistance don't work. The tools aren't the problem, the interpretation is. Retail traders trade signals, professionals trade context. Retail traders ask, did resistance break? Professionals ask, where is the liquidity after the break? Retail traders see a bullish candle and act. Professionals ask, where did that candle form and why there? Retail traders see patterns. Professionals see behavior. And over time, that difference in thinking becomes a difference in results.
Long-term survival in the market doesn't come from memorizing patterns. It comes from understanding how other traders think. Because once you understand what the crowd is watching, you begin to anticipate what smart money is likely to do next. Which brings us deeper into the real question. If liquidity is the fuel of the market, how exactly does smart money find it? And why do retail traders keep falling into the same traps again and again? Retail traders and professionals look at the same chart, but they're not seeing the same thing. When you open a chart, you're searching for signals, breakouts, levels, indicators. You're asking one question: where is price going next? Smart money asks something completely different. What is everyone else thinking? And more importantly, where are their orders sitting? Retail traders treat the market like a prediction game. Smart money treats it like a liquidity game. You wait for confirmation. They often position before it appears. When resistance breaks, you see opportunity. They see liquidity. When support breaks, you panic and sell. They ask whether stops are being collected. This is why the market so often moves in ways that feel confusing. It's not chasing price, it's moving to orders. Retail traders follow price. Smart money follows order flow. Retail traders watch candles. Smart money watches participation. Retail traders focus on outcomes. Smart money focuses on process. And over time, that shift in mindset changes everything. Because the market isn't designed to make the majority right. It's designed to move liquidity efficiently. And as long as you see charts as patterns alone, you stay part of the crowd. But the moment you start seeing liquidity, behavior, and positioning, your perspective begins to shift towards that of a professional.
Now let's define liquidity clearly. Liquidity is simply the collection of orders already sitting in the market: stop losses, breakout entries, take profits, pending orders. These are not random, they are fuel. If a large institution wants to build a position, they need someone on the other side. Without enough opposing orders, price moves too fast and ruins their entry. So where do they go? To areas filled with orders. And once again, those are the exact levels retail traders naturally choose: below swing lows, above equal highs, around obvious support and resistance. These areas become liquidity pools. That's why you'll often see price spike below a key low, trigger stops, create panic, and then reverse sharply upward. It's not manipulation, it's collection. Always remember this: smart money is not searching for price, it is searching for liquidity. And until you truly understand that, you're not trading the market, you're feeding it. Most traders only look at price. If price is rising, they assume strength. If it's falling, they assume weakness. But price is just the final result of a much deeper story. Imagine a stock rises 10%. Looks strong, right? But what if volume was decreasing the entire time? Is that move really supported? Maybe not. Professionals don't rely on price alone. They study participation. They want to know who is behind the move. Retail traders treat price as reality. Smart money treats it as a symptom. Price shows where the market went. Volume shows why it went there. And that difference separates average traders from professionals. If price is the visible story, volume is the hidden one. It reveals participation, conviction, and intent. How many traders were involved? How strong was the belief behind the move? That's why professionals always analyze price and volume together, because sometimes price moves up while volume quietly tells a different story. Volume is the heartbeat of the market. It exposes activity, strength, and hidden intentions. And this is where volume analysis begins. The key principle is simple: effort versus result. Effort is volume, result is price movement. The question is, how much movement did the market produce for the effort involved? If volume increases and price moves strongly, the trend is healthy. But if volume is extremely high and price barely moves, something is off. It may mean an opposing force is absorbing the move.
That imbalance is often the first warning sign of a weakening trend. This is where smart money leaves footprints. Stopping volume appears near the end of a downtrend. Selling pressure is intense, volume spikes, but price struggles to fall further. It looks like sellers are dominant, but beneath the surface, smart money may be absorbing everything. That's why stopping volume often signals a potential reversal. You'll usually see a sharp drop, high volume, and weak follow-through. A lot of effort, but little result. Demand is quietly entering. Now look at a buying climax. This happens near the top of a strong uptrend. Excitement is high, FOMO is everywhere, price accelerates, volume explodes. Everyone believes it will keep going. But often this is where professionals are exiting, transferring positions to the crowd. If price struggles to continue higher despite massive volume, it may signal a climax, and many major tops begin this way. Then there's volume divergence, when price and volume stop agreeing. If price makes new highs but volume declines, the trend may be losing strength. If price makes new lows but volume fades, selling pressure may be weakening. It's not a guarantee, but it's often an early warning. And many reversals begin with this quiet shift. Now step back and look at how most traders operate. They enter without a plan. They spot a setup, jump in, and then react emotionally as the trade unfolds. Professionals do the opposite. Before the market even opens, they map everything: key levels, liquidity zones, possible scenarios. Their entry, stop loss, risk, and targets are defined in advance. They're not guessing, they're executing. Because long-term success isn't built on one trade, it's built on a repeatable process. Even the best strategy fails without risk management. Professionals decide first how much they're willing to lose, not how much they might gain. Every trade carries controlled risk. Capital protection comes first, and real growth comes from journaling. When you track every trade, every emotion, every outcome, patterns begin to reveal themselves. Mistakes become visible, adjustments become possible, and over time, a real edge begins to form. At the end of the day, most traders don't fail because the market is too hard. They fail because they see it the same way everyone else does. They chase signals, ignore context, overlook liquidity, let emotions take control. Professionals think differently. They study what's beneath the surface: liquidity, volume, behavior. Your goal is not to predict the future, it's to understand probabilities, manage risk, follow a disciplined process. The moment you stop thinking like the crowd, you stop getting the crowd's results, and that's where the real transformation begins.